Hi class, today we're going to go over simple and multiple step income statements. This is actually exercise 4.2 in your text, and what I've done here is I've actually added a real life example that I see in the financial services industry. So let's talk about the income statement. The income statement is referred as a change statement. So let's think about a 1 year period. Now think of a balance sheet as taking a picture on your cell phone. So we all take pictures on our cell phone. We have a point in time, right? So that's the balance sheet. Now let's take another picture and hold your finger down your phone. We have multiple pictures. Let's say we have 365 pictures. Think of that excuse me, as your annual income statement. We have 365 days in the year. We have 365 cumulative revenues and days with revenues and expenses. It's like a movie. So we put all those together, and all those points in time become a movie, right? So think about a movie slide, and you have each individual picture, and you have a reel of these pictures. That's a movie. That's the income statement. So each picture represents the change each day for revenue, expenses, gains, losses, owner contributions, owner dividends, anything that causes owner's equity to change during a specific reporting period. Let's call that January 1 to December 31st. So in this video, I'm going to go over an example of a single step and a multiple step income statement. I also want to show you a real life example of an income statement that I see in the mortgage banking industry. It's also called financial services that I work in. The single step format basically lists all the revenues and gains and income from continuing operations. So basically, you have revenue, and you have revenue stream 1, 2, 3, 4, 5, or 1 and 2. That includes gains, that includes losses. So they're all reported together. The same thing with the expenses and losses. Operating and non-operating items are not separately classified, as you'll see in the multi-step statement. And the power of this is simplicity. And lots of times in life, simple is better for reporting purposes. Now, if you're an analyst for some bank, or if you're an analyst for some publicly traded company, you want the nitty-gritty of the stuff, right? So you probably want to see the multiple step income statement for various reasons. So the multiple step format reports a series of what the textbook calls intermediate totals. This includes gross profit, operating income, income before taxes. So very often the income statement adopts variations of these formats, falling somewhere between the simple and the multiple step. And I think that's quite important. So the book tells us that we have two statements. However, in reality, GAAP doesn't tell you, hey, you have to have a single step. It tells you what it actually needs, what you need to report. You need to report your revenues and your expenses, and hopefully those expenses are matched to the revenues that it helps generate. But there's a wide array of variations between the two. So think of simple and multi-step income statements as being the extreme of each, and somewhere in the middle is the mean between the two extremes. So I think that'd be a fair statement to say. So let's move on to our example. So here's a partial trial balance. This is actually in your textbook, Greenwich Corporation, December 31st, year 1. So this is the unadjusted trial balance, and it's the portion of the income statement. So you have sales, interest, gain on self-investments, cost of goods sold, all the way down to income tax expense. It's giving us the shares of common stock because let's go through the requirement first. That's actually, every time you go through your accounting questions, it's kind of like this in the CPA exam, you want to read what's required first. So I encourage you guys to do that with your homework questions as well. So prepare a single step income statement, year 1, including EPS disclosures, and the same thing with the multiple step income statement. So here's part 1. So here's what we saw on that prior page, same exact information. We're going to do a single step income statement. So revenues and gains. From the simple approach, we're going to have sales revenue, 1347, interest revenue, gain on self investments, and we have total revenues and gains. Again, simplicity. Expenses and losses. We have cost of goods sold, selling, G&A, we call it in the industry, or general and administrative, interest expense, and total total expenses and losses. So I think of it as pluses and minuses. You have one column for revenues and one column for expenses. So we get income before income taxes. And that's basically, in the textbook, we use a percentage, but it can get so complex in the real world that it's just, instead of, obviously, income taxes is a different animal in itself, but we just assume certain percentages. So income tax expense is this. And if we want to know the percentage, which is not required in the example, we just divide that by that. You get the income tax percentage. And in this example, we get net income of $298,984. In both income statement approaches, single and multiple, we're going to get the same EPS and we're going to get to the same net income. It's just different ways of different presentations of how we get that. So we wanted to calculate EPS, and that's simple as the net income, $298,894, and we're going to divide that by 178,500. And we get earnings per share of 167. So let's take a look at the multiple income statement. Same information. And sorry, I have the kids in the background. Same information and same heading, but we start out with sales revenue, cost of goods sold, and something new. This is called gross profit. So I had mentioned earlier that the multiple step income statement has different intermediate steps, so to speak. So gross profit is basically just a measure of your cost of what you're buying it for and what you're selling it for. So, and it doesn't say anything in this example, but you can get a gross profit margin. And usually gross profit margins, they're based on industries, right? So if you have an industry like a supermarket and a shoe store, and they both have the same percentage, gross profit, doesn't mean that they're equal. It just depends on the industry average. So definitely keep that in mind in your studies. So operating expenses, we have selling, administrative, we have a total. Then we have something called operating income. So this is where we break off from the single step. We have other income, interest revenue, gain on sale of investments. These are considered ancillary sources of income. So it's not from the core line of business. So remember I had mentioned analysts and banks and anybody else wanting to look at the financial statements. If these were large numbers, even larger than this, that's kind of like a red flag saying, okay, yeah, your net income is still going to be net income, but how you're generating that revenue, what's going on with your core operations, which is not in this example. So it's good here. It's just a red flag if these are huge, or if you have a side-by-side spread of like 3 years, and maybe next year or previous year was like 400,000. Probably want to take a look at that, or question would come up because of that. So we have interest expense and total other income. Again, we have a category. You can also see, this can also be broken out, other income, and then you have other expense over here and have two totals, but this is more simpler, so to speak. Income before income taxes is the same in the prior example. Income tax expense, net income, earnings per share of 167. So those are the two examples, and this will help you with your homework problem in Connect. So here's the example I spoke about. In the financial services industry, banks have divisions that lend money, lines of credit, to mortgage bankers. This is either called mortgage finance, warehouse lending, mortgage warehouse lending. This is what I do. So I'm on the sales side and also wear a credit hat as well. So I do the financial statement analysis, I do the spreads. So here's a current example of what a mortgage company's income statement could look like. So remember, there's no set template for how to present revenues and expenses, or even cost of goods sold, just guideline from what we get in our textbook. And in practice as well. So this has some characteristics of a single step income statement, when we look at revenues. So gain on sale of mortgage loans and service rights, interest income, all those revenue sources are joined together at the top. These are both considered core revenue streams. Would you know that? No. I'm telling you that because I've been in the business. So interest income, this is the interest income. It's usually reported net. And what this is really quick is when we lend money, right? The company earns interest income for the amount of time their mortgage loan is on the line of credit until they sell it to an investor. At the same time, they're getting interest expense. So depending on how they report it, this could be a gross figure. This is a gross figure, and their interest expense is down here, and they also included warehouse fees. Sometimes I will see the interest expense and the interest income netted out. So interest income net would be, I don't have the full figure of interest expense, but it would be a lot less than that. That's how I see it reported, and that's a good example of you don't have to report it a certain way, just as long as you report it consistently. Consistently is the key word here. So a non-core revenue source would be, let's see, selling equipment for a gain or selling securities. So again, this is more of a single step income statement. If it was a multiple step and we had selling equipment for a gain or selling securities, that would probably be under other income or expenses over here. So I would consider those ancillary, not core. So here is the same information that I had, and I'm obviously protecting the innocent. This is now Harrison Home Mortgage. So same slide here. Let's just go over some things that I noticed in my industry. So the industry doesn't have a cost of goods sold. So if you don't have a cost of goods sold, guess what? You don't have a gross profit or gross profit margin. I've noticed, and I've been working with folks in the industry to come up with a way of, okay, what could be a cost of goods sold? So there actually is a cost of goods sold. Some customers that I see actually report that. That can be, processing fees, fees paid to credit reporting agencies. But the problem there is from one mortgage banker to another, they don't report that. They'll still report them, but some might report them under G&A. Some might report them as its own line item down here. So having a gross profit or gross profit margin isn't really good from what I'm looking at a banking point of view. So a manufacturing firm, definitely you need that. Anything, I'm sure a supermarket has that as well, but this is one example of an industry that does not have that. So let's go down to the operating expenses, selling expense, general and administrative expenses. We've learned, in principles of accounting that there's a lot of other line items in here. This is like the catch-all for all those. Usually what you'll see in a financial audit, even in non-audited interim statements, you'll have a schedule breakdown. In the audit, you'll see in audit notes. In the interim, you may not see, you may have to ask questions because what we're doing is we're spreading financial statements and we want to see big deviations. We want to take big chunks and make it granular for our analysis. So you'll usually see those in audit notes. Income before income taxes, this is cool. We actually saw this in the textbook, right? So here's its own line. Provision for income taxes, see note. Note 11, that just means you can tell that this is an audit, financial audit. And somewhere in note 11, it will talk about income taxes. In this particular example, we haven't learned it yet. It's more intermediate accounting 2, but we have deferred taxes. We have tax assets, tax liabilities. That's accounting for income taxes, and that's just a different animal. We'll learn that next class. So this is very similar. What I want to point out here, it's very similar or the same thing as income tax expense. Then net income. So we don't have an EPS requirement. Earnings per share, and earnings per share you're going to do in your homework assignment is mandated for public companies only. So this is a good example of what happens in real life. Non-public company, we don't have earnings per share requirement. But from our example, we do know how to calculate it if we had to. So if there's any questions, please post in class. My goal here was not only to share the school's curriculum, but also to share real life examples because that's what we're all going to be doing eventually, right? So of what I currently do in practice. My aspirations as your instructor are to mix the two. So having both knowledge of theory and personal experience gives me the opportunity for you all to get the most out of your education. So please, any questions, respond to this post, and I can even share more. Thank you so much.